I'm Barry Russell. I'm the moderator and founder of the Real Estate Collaborative. Welcome everybody to the call this morning. We're very pleased that you're with us. And I would like to start off by saying that these collaborative meetings wouldn't happen if it wasn't for the sponsors that we have had join us over the years. This is our 8th year of doing the Real Estate Collaborative. So we've been really pleased with the turnout. I'd like to start with our premier sponsors. Our first sponsor is Russ Keller with the Credit Law Center. Credit Law Center has been using the law since 2009 to help over 30,000 people improve their credit. Russ has been in credit repair himself since 2011, repairing over 900 files. The credit system is often unfair, inaccurate, and difficult to navigate. First, the credit law difference is in using attorneys and paralegals to work on the files. Secondly, they are a pay-for-performance company. That means you only pay for what they make go away. Our next sponsor is Simple Moves. Simple Moves is a local, veteran-owned moving company that has been doing moves in and around St. Louis for over 20 years. The company has a very high level of customer service, as evidenced by its high Angie's List rankings for many years. Simple Moves, owned by veteran Chris Giannino, can be your one go-to mover for local or long-distance moves. Long-term and short-term storage is available. Remember Simple Moves, the company that realtors choose when it's time to move. Linda Borghi founded Dazzle Interiors and Home Staging in 2008. Dazzle stages vacant homes in every price range and in a wide array of size, styles, and architecture. She maintains a very large inventory of furniture and accessories in her Fenton warehouse. The company's response time to client needs is very fast. She works through realtors, builders, and investors. Dazzle has won many awards over the years, including Best of House 2015 through 2019. She's recognized as one of the top home staging companies in the country by the Home Staging and Redesign Association. Brandvine & Company, led by CPA John Brandvine, is a longtime St. Louis public accounting firm. Brandvine has been a CPA since 1958 and has numerous certifications. The company provides business consulting, business and personal tax preparation, and individual tax planning strategies. We have used John for negotiations with the IRS on short sales and been very satisfied. For real estate agents and investors, what John knows could result in a significant savings for you. Above all, John has a terrific sense of humor and is fun to work with. Chesterfield Title is a woman-owned full-service title company with offices in the Chesterfield and Kansas City areas. It is licensed in Missouri, Kansas, and Illinois. The company serves its clients through in-office or remote closings. Their team of talented professionals has an average range of 10 to 25 years in the industry. My experience is that their personnel pride themselves on quick turnaround time and accurate results. You'll enjoy visiting with Regional Account Manager Mimi Brandt. Owner and founder of Design to Sell, Andrea Lenson, leads a team that specializes in occupied home staging services. Andrea has been one of the top staging professionals in Metro St. Louis area for over 5 years. She understands the importance of depersonalizing a client's home to appeal to the widest range of buyers. This makes the realtors' jobs easier so they can focus on marketing the property for sale. The company offers multiple services in addition to an inventory of accessories to assist with attractively staging houses. Design to Sell has won many industry awards, including National Award for Top 5 Stager and Best Occupied Stage of the Year. Denise Reed represents Strategic Financial Group, whose securities and investment advisory services are offered through Cetera Advisory Networks, a broker-dealer, a registered investment advisor, and registered investment advisor. Based in Manchester, Missouri, Denise and her team partners educate their clients about financial concepts and products and take the mystery out of investing, insurance, estate conservation, and preserving wealth. They can help you create an approach that is designed to address your unique situation. Concert Homes is a small production builder that builds approximately 100 homes per year. It's proud to build energy efficient homes by including structural details and systems that keep utility costs down for homes in all price points. Concert offers a variety of features, finishes, and upgrades to help personalize a house to make it a home. They're currently building in communities in Lake St. Louis, Wildwood, Eureka, and coming this summer to St. Charles off Boshertown Road. They are the second generation of the Jones Company, a well-known St. Louis builder. As an independent representative, Deborah Russell represents Legal Shield and their ID Shield identity theft plan. The company has been around almost 50 years, assisting individuals with affordable legal services and with comprehensive identity theft protection. Realtors and other licensed professionals need to protect their licenses from the growing identity theft threat. Identity theft could shut down one's livelihood and could take hours to resolve when an issue occurs or when an identity is stolen. Deborah has arranged for a very affordable discounted group rate for attendees of the Real Estate Collaborative. Short Sale Specialists USA is a joint venture between myself, Barry Russell, and Rod Hamilton. Together, they have been providing contingent, fee-based short sale services to clients throughout Metro St. Louis for over 11 years. We work closely with realtors, CPAs, attorneys, and financial planners who bring their clients who are having financial hardships and whose homes have mortgage debt exceeding their value. Negotiating service enables the listing realtor to preserve their commission. Our motto is helping people sleep again. I'm going to do the event sponsor group in between the two sections of the webinar today. So I'm pleased that we can welcome everybody to the call this morning. I noted that Lauren Johnson has joined us, so it's great that she's with us. I'm going to introduce our panelists. Our panelists this morning are Colleen Lawler, Lauren Johnson, and Shawn Kelsey. I know a little bit about each of them, so I'm going to have them talk more than I am. I do know that Colleen Lawler is the owner of the Irvine team with Coldwell, Gundaker, and Chesterfield, and she's been in the business for over 30 years and has got amazing credentials. Colleen, would you like to tell us a little bit about what you did before real estate and what other things you'd like people to know about you?
I don't know if there was anything before real estate. Actually, I went to St. Louis U. I was a nurse for 10 years and accidentally became a real estate agent when I was preparing to purchase a home. And I would say that the skill set's the same. People are stressed when they're sick. They're stressed when they're buying and selling. As a nurse, you're herding a lot of cats, I guess you could say, on a hospital floor between X-ray and lab and doctors and therapists. And in real estate, you're just working with lenders and buyers and sellers and inspectors. So it was a pretty easy transition, kind of out of the fat and into the fire. I've been doing this for 32 years. Last year, I sold about 150 homes. I have a team of 3, which is pared down a little bit, but with the pandemic, but also with all of the technology there is now, that's shifted how quick we can turn in this market and how much easier it is to market with a lot of web-based strategy.
Great. Thank you, Colleen. Good morning, Lauren. How are you? You are muted, so I'm going to ask that you unmute yourself.
Hi, thank you so much for having me.
Glad that you're on board, and I know that you are a big success with your Lux Real Estate out in St. Charles, and you do. I know you do deals all over St. Louis, and that you had a marketing background before real estate.
Yes. So I am Lauren Johnson. I'm the owner of Lux Life Real Estate of Keller Williams Realty West, and I specialize in residential real estate. And I reside in St. Louis County. We are part of the Keller Williams Realty West office out in St. Charles. We have great loyalty out there. We do service the entire St. Louis greater metro area, anywhere from as far as downtown, as far west as Warrenton, as far south as Jefferson County, as far north as North County, and everywhere in between. We have a full-time team of 7 licensed agents. Some are admin, some are sales, and we live all over the St. Louis general area in St. Louis County and St. Charles County. We typically sell about 150 to 200 homes per year. And this is my 15th year in the industry. I graduated from Mizzou in 2007. It was a great time to try to find a career, and there were not many careers in PR, advertising, marketing when I graduated. So I decided to follow my family legacy. I'm a third generation realtor on both sides, tons of brokers in my family, and jumped into residential real estate. The rest of them are all in commercial real estate. So I joined in 2007 and started doing a lot of new construction, that kind of thing. Still earned my master's degree in marketing, PR, advertising, which I apply to my business today with a lot of branding. And I love what I do. And we love helping people find their favorite home and helping everyone achieve their version of a Lux life. And
Great.
Lux Life Real Estate, live it, love it, Lux it.
Well, wonderful, Lauren. Glad you're with us. Good morning, Shawn. I know that you have been in real estate for quite a while, and you are the managing broker for the Redkey Realty West. Redkey Realty Leaders, Chesterfield West. Could you tell us a bit more about you? Because I know you've got quite a background.
So prior to getting into real estate, actually I worked for Best Buy for about 15 years. Worked closely with many people know Brian McCrae, who's part of this event as well. So I was regional marketing manager over about 45 stores. And one year the company had a really bad year financially, about $8 billion in revenue and about $1 million in net profit. So they were cutting positions left and right. So I was one of 22 positions that got reduced to 6. So my choice was to move to the frozen tundra of Minneapolis. And my wife said, well, if you move there, you should write me because she would still be here in St. Louis. So at that point, I thought, okay, perfect time to get into real estate, which is why I originally moved to St. Louis to begin with. So I made the shift to real estate. When I was a marketing manager at Best Buy, I was a self-appointed numbers dork, which I am as well in real estate. So to me, the answer was always in the data. And when I got into real estate, I'm like, it certainly still applies here. So that's why I'm really statistical oriented from that standpoint. What I love about my job really is just the problem solving for the agents, the training, et cetera. And I've been a broker since about 2000 for Redkey, Keller Williams, and then my brother had a couple independent companies. So that's kind of my background.
Great. Thank you. I'm Barry Russell. I'm your moderator. I originally grew up in the far, far north tundra of Winnipeg, Canada. I am a broker. I have been a commercial real estate developer for most of my career. And today I have several businesses, including the Real Estate Collaborative, a short sale venture that you heard about, and one other activity. I'm pleased to be your moderator, and we're going to start with our first panel, which is really titled, Do We Have an Overheated Residential Real Estate Market? And, you know, as I look back at a year ago when we had a panel that asked the question, dealing with the uncertainty of the COVID-19 real estate market, well, we've been going through that. And the residential real estate market, I think, has surprised me and maybe a number of you. And for many people, for many agents, it was a really good 2020. So the first question I have for the panel is what possibly is an historic low monthly inventory of available houses to purchase? Is the overall St. Louis market seriously overheated? Will this situation simply drive prices to unsupportable levels for the long term? I think we'll start with Colleen.
I saw an article in the Wall Street Journal this week that said that there were more real estate agents than there were houses for sale in the United States. And I went, well, that'd be really interesting. I don't think we can sustain with one sale a year, if that's what the gist of that article was. We do have, in 32, really 33 years of real estate, I've never seen listing inventory this low, and I haven't seen so many buyers lined up at so many new listings ever. I don't know how long it's going to go, but we really saw it start at least a year ago in certain little pockets where, for instance, down in Mackland in South City, people were just crazy. 15 months ago, trying to buy a house, there would be 20 offers and things were flying like they are right now. So we did have some indication that there was that kind of demand. Right now, I think we're down compared to last year by about 24% in terms of listing inventory. We're down in terms of closed sales compared to last February by just under 6%. And pending sales are down about 9%. And pending is a leading indicator, so maybe our closed sales is going to go down. I don't know. It seems like one of the things holding inventory is so many people not knowing where they're going to go. There's an agent in my office who sold their house, and I offered to let them move into my basement because they're under contract. They can't find anything, and they can't even find a rental to get into. So it's just kind of like all bogged up at one end. And certainly I think inventory, it's all a matter of inventory. And if we see some inventory rise, then we'll see a little bit better days on market, better opportunities for buyers. And I don't know where prices are going to go. I'm surprised that we don't have more appraisal issues than we do. I've had a couple. One in particular was an appraiser, and this is really interesting. She said that an appraisal should be what an unpressured buyer and unpressured seller come to as market value. And that certainly buyers are pressured now. So she's just not going to appraise anything more than $1,000 or $2,000 over the list price. And I thought, oh boy, it's a good thing there aren't too many of her around. This week I had somebody, they had me meet with them about selling their home. For the only reason is because the market is so hot. A year ago, they put $100,000 into their backyard with a fabulous pool. They back up to a lake. They had been gypsies for probably 10 years before that, never getting roots down. And now they were like, well, we think we're probably going to move in 5 years. Maybe we should sell right now while the market is so hot. But we love our home, and we've never stayed in one place, and we would love to stay in one place. And I told them I thought they were trying to guess what the market would be in 3 to 5 years. And can any of us guess that? I don't know. So it's interesting. The reasons people are on the market right now certainly are people are weary of COVID and trying to make a change to a space that suits them better. In the last couple of weeks, I've bumped into some people with forbearances and tax liens, and I wonder if that's a leading indicator that some of the kerfuffle early in COVID and some of the people truly impacted by it, if we're going to start seeing that maybe between now and September.
Yep.
I don't know. All good questions. I'm interested to hear what other people say.
Shawn, I'm going to ask you a second question, and you can add in a few thoughts on the first one if you like. Is demand starting to fall in any segments of the Metro St. Louis marketplace? And then is the vaccination progression helping with supply yet? Meaning people feel comfortable.
Not really seeing evidence, Barry, of the supply coming up because of vaccines happening, et cetera.
Okay.
To me, the market is really, if we say overheated, I also look at it as it's just simply undersupplied. It is always supply and demand driven. And the months of inventory, NAR says if we have 5 to 6 months of inventory, that's a balanced market. We haven't been below 5 months of inventory as a corridor since 2015. Right now, St. Louis County is at about 1.1 month of inventory. St. Charles at 0.7 months of inventory, and the city is the highest at 1.42. So that would generally speak to sellers markets across all those markets, but it's not in all categories, price ranges, et cetera. For example, I looked up ranches in Parkway South a couple days ago, and the 77% of the closed sales since January 1 were over 100%. So 3 out of 4 over 100%, 103.5% list to sale price ratio there. And there literally was a 0.27 months of supply, so a week's supply of inventory if you're looking for a ranch in Parkway South. So that kind of brings the question of, can these prices be pushed higher to start versus just everybody going $15,000, $20,000 over the asking price, whatever those numbers are. We had an agent about a week ago wrote on a property, and there were 31 offers at $280,000. And when there's 31 offers, obviously that's annoying for an agent to have to go through, et cetera. But it really speaks to, you probably could have started higher. Could a 280 have started at 300? I would probably think so. So because there are people getting caught up on, I don't want to pay so much over the asking price, but I always look at it as, if the asking price were a little bit higher, would you have done anything differently? Probably not, because on that particular property, you got 30 buyers waiting for the next property to hit the marketplace, right? Part of what I also look at too, and this is to Colleen's point about the pending inventory, I'm looking at under $500,000. That's where the sweet spots of the market are basically. So from 199 to 300,000 in St. Charles County, 77.6 of the properties are under contract. So if 8 out of 10 of all the properties are under contract, that speaks to how fast that market's moving. You bump it to 299 to 500,000, it's still 72%. Now, as you increase the price ranges, 500 to 700, it drops to 63, 700 to a million, 62, and then you go over that price point, it's about 57%. So it's not a seller's market in all price points, in all categories, in all counties. So
it's helpful. Lauren, what would you like to add based on what you're seeing, please?
Sure. Frankly, we are having a lot of appraisal issues. So last summer, we had a buyer who was purchasing a property in Baldwin, and the appraisal came in 68,000 below. So this property, super sought after, they had a pool. The previous owner overly improved the property. He spent 140,000 on the backyard and the pool. These buyers felt like this house was worth it to them to pay $68,000 above appraised value because of that luxury of that backyard and that pool and that oasis. Because they said, we're going to be here for over 10 years. This is our dream home. And 68,000 above appraised value is going to be less to us than paying for 100,000, 140,000 for that same pool to recreate another home. So we are having an upside down market already right now on our team. So one of my colleagues, one of our other agents who works with me on our team has a buyer under contract right now, $750,000 price point in West County. And the appraisal just came in just a few days ago, 218,000 below 750. So, I mean, 218,000 is a huge discrepancy. So we're already having these struggles. It just depends if people are willing to pay above market value, like those first buyers I just mentioned to you or not. If they do, frankly, they better just stay in their homes for a while because they're going to be upside down. It just really depends. We have a connection with another agent in Utah, and she wrote on a property at $599, list price $599. She wrote with her buyers at $850 cash, as is, no appraisals, no inspections, and they did not get the house. So these buyers wrote $250,000 above with that strong of an offer, and they're not getting it because there are so many other offers above $250,000. So this market, honestly, guys, I've never seen anything like it in my 15 years. I've never seen or heard anything like it prior to myself being in the industry. I think it's wild. I think it's crazy. And we'll see what happens. I think it's for us to be the professionals to really educate our clients and educate everyone out there and all the consumers. Are you doing the right thing? Do you really want to pay over this? Is this really worth it to you? Like, let's look at all your options and decide if it's worth it to you. We do have skyrocket, interest rates are super low, so we do have that. But at the same time, it is our job to educate and make sure that they know what they're getting themselves into and if this really is worth it or not to pay substantially above the value.
That's very interesting. I know that I have a retired economist friend here locally, and he follows the Seattle real estate market, which I do also because I have family there. And it has peaked, it would appear. It's coming down. This gentleman feels that Seattle is a bellwether for the rest of the country. And so, the market out there is crazy. It's crazier than its price acceleration, and it's been much higher than here, and not as high as San Francisco. For what that's worth, that market has apparently peaked. So is there anything that is being done that by the Biden administration in particular that's causing this to be worse or better? Is it just the same? I know the extension of forbearances has put off the day of reckoning. I'm actually doing a webinar on forbearances here coming up. And do you think the forbearances will generate enough once they're over, which appears that many of them would be up at the end of June? Do you think they'll generate enough listings to help significantly? Colleen, what do you think?
Boy, I don't know. Forbearance, if it does, in one way, if people are in forbearance and then they're going to need to sell, they're going to come out pretty good.
Yeah,
with
they
the way
are.
prices have accelerated. So hopefully we won't have people just really in dire financial straits, aside from needing to sell a home. And then who knows if they have to downsize or whatever, if there's going to be anything there for them. I heard early on, probably January, February, that there was talk in the administration of doing a first-time buyer stimulus. And I was like, don't, we have no houses. What would be the point of that? So luckily I haven't heard anything more about that. It'll be interesting to see too what happens with rentals, and I think St. Louis County is starting this week that they're going to start letting landlords act for people that have issues and haven't been paying rent and maybe have
Eviction.
some illegal activity.
Yep.
So it'll be interesting. I've been concerned about the small investor that has one or two investment properties where they haven't been able to evict or collect rents, and how that's affecting their overall financing. So it'll be interesting to see how all of that shakes out as well. I believe Yellen said that they aren't going to raise interest rates until probably 2023. Of course, that could always change, but low interest rates, I'll always be a fan of. I bought my first house with a 15% interest rate. And I think when I came into real estate, it was at 12, which would be today, that would just be like the brakes. But back then I was like, okay. And we sold houses and I didn't know that was a little hard. So interest rates, I think, are a lot of fuel to this fire, and a lot of people just almost see it as free money, and they're willing to pay more to get in because every $1,000 that they're borrowing is of hardly any consequence in terms of raising their house payment with interest rates this low.
So Shawn, if somebody asked you whether this was a good point for them to buy, just let's say they're looking at this as a cycle, and you get somebody who isn't maybe comes into this market from a different city, or just has been sitting on the sidelines. What's your advice to them as to whether they should buy now?
So I'm all in because of the interest rates, just like Colleen said. It's really going to continue to drive the market for some time. Again, we don't think rates are going to go up anytime soon. From my view, I mean, 3% is obviously cheap money. You know, people are spoiled by that. If it gets to 4%, does that cause a little bit of hiccup? Probably. Does 5% put the brakes on? That's kind of the thing I'm looking at. I mean, I remember a few years ago when gas hit $4 a gallon and you couldn't pay realtors to show your listings. So I think that's a more visible daily event for the buyers, that they know what they're paying in gas prices. So if interest rates creep up an eighth, we get used to anything over time. So I am all in. I am thinking the next hiccup we're going to have in real estate is when rates do get to like a 5%. You know, what happens then when I'm at 2.75? I don't really want to be moving if rates are 5 because I've lost 20% buying power.
Yep.
So I think people will get trapped in their houses at that point. So Lawrence Young of NAR, I think, was out a few days ago and was talking about the forbearance, and to what you already said earlier about the amount of equity people have because of the increases over the past couple of years. So I do not think we could add enough inventory to really have an impact. I mean, obviously June 30th, if that's the deadline, we're not going to see any inventory hit July 1st, right? So that would just kind of flow in gradually over time. So yeah, I don't think we're going to add enough inventory to really have an impact. I mean, if you go back to 2011, Barry, and that was kind of as we're getting out of the bottom of the market, for St. Louis County, there was 6,288 active listings in June. And if you compare that to what we have right now, it was 783 at the beginning of the month. So it's an 87% drop for St. Louis County, 90% for St. Charles. I mean, obviously 6,288 was too many, 783 is too low. So what's the number of inventory that's right in between there? And even if you look at distress sales, as you know, again, back in 2008, it was about 40% of the marketplace, between foreclosures at 27%, short sales, your world, at 13%. 2018 and 2019, it was 1%. obviously 2020 because of the moratoriums, it was less than 1%. But yeah, I just don't think we could add enough inventory to really impact the market, because even if there are those foreclosures, et cetera, who's going to buy them? The investors. I mean, we're seeing investors writing cash offers over asking price, waiving appraisal riders. So I was with an investor of mine yesterday. He's like, I'm not buying. I'm not going to be paying over the asking price. I mean, I've always felt when you do rehab, your money, your profit is made on the buy side. If you overpay for the product to begin with, you have to pass that number on to the buyer or reduce your margin. So yeah, I'm not concerned about the inventory changing dramatically with what would happen in June, July, et cetera.
So Lauren, do you think there's anything built into this market from the buyer's standpoint about a fear of inflation? In other words, I better get in now because prices look like they're just, is there a perceived inflation, concern about inflation, or real inflation going on just in the housing sector? What do you think?
I think there might be a little bit of a fear of inflation. I mean, constantly they're asking us, like, what do you think is going to happen? Is the market going to turn? What's going to happen? And I mean, to your point about whenever we were talking about maybe stimulating the economy and whether or not there's going to be an incentive brought back, Congress hasn't yet passed it. And frankly, at this point, we truly don't really need it because we have a whole surplus of buyers. We really need to do something to stimulate and get more sellers out there realistically. So, I mean, right now with inflation happening, I mean, it just depends. I mean, I'm not sure. Who knows what's going to happen? It's hard to say with the market and everything, how it's going and where it's trending and everything. But I think the real issue is just we need to get more inventory out there however we possibly can. Has anybody heard of the reverse contingency? Anyone?
Have you? Shawn has maybe? Reverse contingency.
I did it on my own house years ago when the market wasn't, there's only one house we wanted to buy. So if we didn't buy that house, we weren't selling our house. So we literally wrote it for contingent. We were selling our house contingent upon us being under contract on the house we wanted to buy by Tuesday. And it was a Thanksgiving weekend.
Okay, cool. So with the whole reverse contingency, that's something that I'm really trying to hit off hard. This was a concept that was very popular in the early 2000s. And basically what the concept is just like what Shawn just explained. So I will tell my seller, hey, listen, we're going to go ahead and sign up your paperwork today and list you, but we're going to put a clause in your contract that says that we will accept a contract, but you cannot close until July 1st of 2021 or after. So that gives you ample time to house hunt with us to help you find the next property. So that means that your buyer must be contingent upon you finding the right home to move into. So this is a concept that I'm really trying to promote hard right now. I'm working with our legal team at our office and our broker as well to put together a marketing plan for this so we can promote this. I really feel like in our own St. Louis market, we can help get a ton more inventory back, because that's the thing. Like, how many of us have a ton of sellers in our pipeline right now who are just not moving because they're scared, is COVID going to come back around, or, there's just nothing out there and they don't want to put their home on the market and be homeless and all these different things. So this could be a truly amazing win for us if we can really help educate again and sell people on the idea of the reverse contingency. So great, let's meet today. Let's sign the listing paperwork. Let's put you on the market. And let's just say that your buyer cannot close until sometime in the summertime,
So that's great, helpful. COVID-19, once it is aided enough, which it could be by the third or fourth quarter, everybody feels like it's history, or at least from all practical standpoint, that could loosen up the supply. Don't you all agree?
Yeah, Barry, we were in Las Vegas at a real estate convention last March 13th when everything was closing down. And it was amazing. As a broker, the phone kept ringing of my buyer wants out, my buyer wants out. Everybody panicked, nobody knew what to do. So even as we go into April, May of this year, because last April, May, sellers didn't hit the market. They just sat on their hands and not knowing what to do. So we're going to see an increase in inventory naturally this year, just because more people are confident with that.
Right.
Just with the lack of inventory, I mean, it's all going to always keep coming back to that we need to get sellers on the market. So I think they're going to be more comfortable. Just not really seeing the evidence yet that you asked about earlier with the vaccine people coming on.
I would say that even in the last 30 days, because of older people getting vaccinated, were a lot of elderly in their homes that stayed in their homes because of COVID. And I'm probably working with half a dozen families that now it's time to get mom and dad moved. And so families that are out of state that are moving people closer to them now. So there's a little bit of a pent up with people that maybe were going to age out of their houses a year ago, that now that is starting to loosen up. And I probably have, I think I have like 4 pending sales and a couple of closed already this year. Because of that, they couldn't allow showings. They didn't want them, they couldn't fly them across the country. They didn't want them locked down in a senior facility. So that is just starting to loosen up, and I'm really seeing that it won't help St. Charles. That's kind of a younger market, but the West County market, with people that are original owners, say in Chesterfield, Baldwin, that Manchester, that area, starting to see that loosen up and bring some inventory. Might be a little dated, but this year that doesn't matter. But it's bringing some inventory into the market.
Well, that's a very positive note that we can close out the first panel on. There's some hope there. And I wish we could keep going, because this is really wonderful. You all brought so much to the table, from the reverse contingency to all the statistics of Colleen and Shawn. Thank you all three. Before we start our second panel, I'd like to just introduce our event sponsors, who are the folks that also make this event possible. They're starting with the McCrae team of Central Bank Mortgage, and I'm going to have Dan put there he is, he's screen sharing. So the McCrae team takes, and many of you know the McCrae team, takes pride in designing various options and solutions so the customer has a clear, comfortable picture of their selection. In addition to providing all standard comprehensive mortgage options, the McCrae team can also provide unique portfolio loan mortgage options for atypical situations. Their greatest satisfaction comes from helping as many people as possible achieve their home ownership or refinance goals. Dennis Cooper is Senior Vice President of the Federal Savings Bank, and he'll be speaking in a moment. They're a veteran-owned mortgage bank certified in all 50 states. With his focus strictly with the home equity conversion mortgage products, Dennis assists seniors in all 50 states. After 25 years in insurance and financial planning, he found his true calling, assisting seniors who are approaching retirement or attempting to live their best life in retirement to maximize their hard-earned assets. Dennis is also a board member of Aging Ahead and the Kaufman Fund. Dan Lewig of the Insurance Store, he's a principal in the Insurance Store, it's an independent insurance agency servicing residences and businesses in Metro St. Louis, including Illinois. Dan meets the needs of numerous clients by finding them the best coverage at the most competitive cost based on their specific needs. He works for his and your clients, not the insurance companies. His firm represents many different companies, which is a distinct advantage in today's marketplace. He also covers multifamily and commercial properties and business insurance. Jim Colombo, the owner of STL Home Paint Specialist, runs a high-quality interior and exterior painting company. He specializes in quick turnaround, top quality painting jobs for homeowners, agents, resellers, and stagers. He's done everything from mansions in Ladue to rentals on a budget. Old Republic Home Protection is represented by Marcia Russo. Since 1974, the company has been providing home warranty options to the real estate community. Their plans help homeowners avoid unnecessary out-of-pocket costs for repair or replacement of a home's major operating systems and appliances that fail due to normal wear and use. Old Republic's home warranty coverage provides convenience and peace of mind for their plan holders at reasonable rates. Knox Malus represents Integrity Title Solutions, which has grown from a single location in St. Louis to multiple locations in the Midwest. Their expert residential teams offer realtors and their clients the ability to work with the same familiar integrity professionals on their transactions throughout the region. These include construction dispersing, and 1031 exchange services. The company can accommodate closings anywhere in the U.S. by way of an allied business relationship. Rick Brown, one of our panelists coming up, has been educating seniors, realtors, financial planners, and other professionals about reverse mortgages, or also known as HECMs, for the last 18 years. He's worked for reverse mortgage funding for the last 5 years. Rick says that since he understands HECMs, they are obviously not brain surgery, but the concept usually is new to seniors. His focus continues to be explaining HECMs to seniors in a comfortable personal setting, often their kitchen table. Denise Reed of Paget Business Services knows the stresses of running a business can keep owners awake at night. Your business is your livelihood, so it's no wonder it's always on your mind. Paget is here to help. They can provide full service accounting, bookkeeping, payroll services, tax planning and preparation, government compliance, and planning for the future. These services can help your business reach new heights, allowing you to rest easy. To sum up, Nathan Kirpin of Benchmark Mortgage and his team can be a bit of a challenge. They are much more than your typical home mortgage company, which is why he asked that I share a few of many hashtags he and his team live by. Champions for the American Dream, helping you win the money game, your mortgage coach. Despite being a nationwide direct lender, the Kirpin Group's focus on community, relationships, quality service, and systems are all built to help you and your clients prosper. Jim Manning and Ryan Wessels lead a company called 3 Doors. Their company unites agents, investors, and vendors into a force for good to elevate real estate lives in the community. Their abundance mindset is providing endless opportunities to those looking to buy, sell, and invest in real estate. These two have worked as agents, real estate investors, property wholesalers, and as coaches of other real estate investors and agents. Real Producers Magazine is a monthly publication that is received by the top agents in the industry. They hold monthly networking events along with large quarterly socials. If you'd like to get in front of top agents, reach out to Diane Collins to see if working together is a good fit for both of you. You will not be disappointed in having a chat. And finally, Jeanette Neely is the owner of the very successful Nothing Bundt Cake stores in Town and Country and now in St. Charles. Nothing Bundt Cakes as a brand has grown nationwide. Each bakery has the warmth and nostalgia of its home kitchen roots, but also takes a modern approach for the world today. One thing is certain, perfection is all they offer. They make excellent gifts for realtors and lenders to give to their clients. So I'm pleased to have our second panel, we have two wonderful folks who are the panelists for us to discuss reverse mortgages. So the title of our second panel is Maximizing Your Baby Boomers Buying Power with Reverse Mortgages. You've already heard the backgrounds of Rick Brown and also of Dennis Cooper. In the interest of time, unless they have something specific that they'd like to add, Rick or Dennis, I'm going to move into the subject at hand. You got to take yourselves off mute. Rick, you're on mute still. Top right of your screen. There you go. Good. So, this is a field that puzzles many people. And I really want to have us understand, without going into all the details, because there are many little cul-de-sacs we could go into. But I'd like you kind of to give us a quick overview of the product and how it might help seniors in general. Dennis, what would you like to say about that?
Well, coming from the insurance and financial planning.
Dennis, you're going to have to speak up. Your volume is too low, or you're farther from your computer.
Is this any better?
That's much better. Thank you.
Okay. Coming from the insurance and financial planning field, I look at this product as more of a financial planning tool than a mortgage product. I've never done a conventional mortgage. I specialize only working with seniors. Being a senior, I'm allowed to say seniors. So when I start seminars completely wrong, according to the experts. I ask for a show of hands how many people have heard something negative about a reverse mortgage. It used to be half the room would raise their hands, and they only come up with 2 things, but half the room would raise their hands. Since Tom Selleck started working for us, it's down to 3 or 4 people. I don't know what the effect is with Tom Selleck, but he seems to be doing a good job. They only come up with two things. Those two things are the bank is going to take my house, or it's more expensive than a conventional mortgage. And I look at them somewhat sternly and I say, think about it for a second. It's not that lenders are good people. It's just the longer you stay in the house, the more money the lender's going to get. Why would they ever take your house? If you don't pay your property tax, the county might take your house, but the lender's certainly not going to take your house because they want you to live there forever. The longer you live there, the more money they're going to make ultimately. The second thing they say is more expensive, and I agree with them. It is more expensive. Have you ever gotten insurance and not paid for it? This is a fully insured home equity loan. It's the only home equity loan I know of that's fully insured to protect the heirs. There's no way the heirs can lose money because it is insured. For example, if there's a $200,000 villa, I lend $120,000. They live there another 20 years and never make a payment. Interest accrues, and somehow the loan balance grows to $250,000. The heirs get the house from their parents when their parents are no longer living there. They sell the house for $200,000. They owe the lender $190,000. The difference between the loan balance of $250,000 and the $190,000 the heirs pay is paid from the insurance pool that HUD controls. The lender's going to get 100%. It's not a short sale. It's a non-recourse loan. So having said that, that's sort of why I like the product so much. We're all living longer than we expected. Everything costs more than we expected. Pensions have gone away and no one's overfunded a 401k. Why would you ignore a tax-free bucket of money that you could actually utilize? Probably the neatest thing that's happened over the last 8 or 9 years with the reverse mortgage product is that we're now allowed to use to help realtors purchase homes. In the past, you'd have a client with a 3-story house and they didn't like going up and down the steps. You'd help them sell that to create a bucket of money. They want to buy a $200,000 villa. I use 200,000 because the math's easier for me. They want to buy a $200,000 villa. In the past, they had two choices. They could take that entire bucket of money that you got them from the sale of the 3-story house and purchase it outright, or they could take part of the money you got them for a down payment and then have a mortgage payment. Well, any financial planner worth his salt will tell you that you shouldn't put all your investments into a house when you're 62 years of age or older, and nobody at 62 wants to have a mortgage payment. So 8.5 years ago, HUD came out and said, suddenly you can use a reverse mortgage to purchase a home. How that works is you still help them sell the 3-story house, create a bucket of money. I look at a $200,000 villa at 65, I can lend about 50%. I show up at closing with a check for $100,000. The client shows up with a check for $100,000. They purchase, move into, and live in a $200,000 villa, having paid $100,000, and will never have a mortgage payment as long as either of them live in the house. I told that story to a retired vice president of HUD here in St. Louis. Apparently, he was at lunch the day they announced this because his reaction was, 4 days later, he called me and said, instead of that $200,000 villa you were talking about, my wife and I just put a contract on a $400,000 house. They were older than 65, so I could lend more money. I showed up at closing with a check for $253,000. He showed up with a check for $125,000. They only offered $375,000. But 4 years ago, they purchased a $400,000 house for $120,000. From a real estate standpoint, you show somebody a $100,000 condo that they're willing to pay cash for, you can sell them a $200,000 condo for the same amount of money, and they never have a mortgage payment. They're twice as happy, and you get twice as.
That's interesting, Dennis. That helps put it into perspective. And I know that Rick, you've got some thoughts to contribute here as far as what is this a good idea? What do you think are some of the limitations and advantages?
Well, I'll talk more about the advantages if you don't mind.
Sure.
Limitations are really not too big, so I don't have time to go into everything. Picking up a couple of things that Dennis said. What he just described is how the reverse mortgage gives seniors more purchasing power. And one of the things you and I talked about was maybe saying how the reverse mortgage might be beneficial not just to the seniors, which is the most important thing, but also to the real estate pros themselves. And so I've been kind of focusing for my comments here on how it might benefit the realtors who are real estate agents who might like to dig into this. you have more purchasing power, that's for sure. When you have more purchasing power, that means that seniors can buy, as Dennis just described, cooler houses than they had in mind and still afford them. That would make for an easier sale. And I'll give you an example here in a minute, some numbers where, you know, seniors think, well, we think, first of all, we can sell it for this amount. You know, that's too high, the current house. And we've done some work and we think our budget for the new house is something else. And you know that based on their current house, that they're not going to like the houses that they just told, you know, in the price range they just described. So what happens a lot, I'm told, is you show the seniors a bunch of houses, they don't like any of them. They take their house off the market and they don't move. Recently, my company, Reverse Mortgage Funding, did a survey, I think one of those Survey Monkey things, asked a bunch of previous, all or most of our previous reverse mortgage for purchase customers, which, by the way, you mentioned HECM, we pronounce that HECM, and it stands for Home Equity Conversion Mortgage, which is actually the real term for reverse mortgages, which is the slang term. And we have another slang term, we call it H4P, which is HECM for purchase. And like I said, it gives them greater purchasing power. It turns out they are willing to buy more than they thought they could, which means a more of a commission for the sellers, for the real estate agents. And also they're willing to actually sell their house at a price that's, you know, it's going to sell for anyway. And that means you have quicker sales, fewer visits, fewer showings. And I think those things all add up to faster sales and actual sales.
Can somebody get pre-approved for a reverse mortgage?
Sure. Absolutely. Dennis, I will agree. We absolutely strongly recommend it. Ours is what we call a golden pre-approval. It's basically almost completely underwritten, so that once they proceed, it's like, you know, there's no problem at all. We just do it quickly. So anyway, going back to the buying power, actually, I gave an example. I kind of made one up, and I'm going to read it quickly so I don't get my all tongue-tied here. But here, this is an example. The house prices I made up, but the numbers associated with reverse mortgage, I did not. There's a 70-year-old couple. They own a $400,000 house. They insist on listing it with you for $450,000. On some basis, they figure $300,000 is their new purchase price in a place they like or something. However, you know that they're never going to like any houses in the $300,000 range based on your conversations with them. Okay. All right. So subtracting. So they sell it for $400,000. We'll just talk about that. Forget the $450,000. They sell it for $400,000, or they're going to sell it for $400,000. Take off, and I'll just say 6% real estate commission. Maybe it's more, maybe it's less, but let's use that number. So they net. They sell it for $400,000, and just say it's free and clear to make it easy. They net $376,000. So three options are buy it all, pay all cash for the $300,000, and have $76,000 left over. They can get an 80% forward mortgage. You can figure out the numbers yourselves. Or they can get use a reverse mortgage. They would combine $141,000 of cash at closing with $173,000 reverse mortgage, and they would be in that house with no monthly payments and $235,000 left over to add to their portfolio. And financial planners love this. I assure you, and Dennis will agree, and we can't prove this today, but we'd love to prove it individually with you in meetings or whatever you want to do. Financial planners who these days use what they call modeling software, and they use it to predict the probability of success, which they define as having more money, or seniors, having seniors' money outlive the seniors themselves. I've seen it many times when they've run these numbers using the reverse mortgage as a purchase loan. In this scenario, it's like 99%. It's unbelievable. So it's something to think about. But just finishing off this example, I told you a while ago, they don't like $300,000 homes, but you know, and maybe you can introduce to them that they maybe can afford something more like a $340,000 home. So you somehow manage to get them to look at a couple of $340,000 homes. They fall in love with one, they can afford it, they still have a pile of dough left over to add into their portfolio. And again, the financial planners think this is the best thing since sliced bread. So that's cool. A couple other things real fast for real estate pros. Number one, it taps them into this ridiculously underserved market, as Colleen was talking about a little bit before. And it's a huge market, and folks, they are interested in moving. In fact, my opinion is in our metro area, there's at least a couple thousand folks that are seniors that are living in what I call ill-suited quarters. They think they're stuck there forever, and they're not. Here's another quick one. Make sure you understand this. Sometimes somebody with a reverse mortgage with the current home, get a reverse mortgage on it to free up some cash to buy or help buy a second home. You have to have the reverse mortgage on the primary and you have to live there, but you could use some cash to buy a second home. That's an option. And then finally, I think the last thing I'll mention, I could mention more, but you're probably gonna tell me to shut up, is this can really get you in with financial planners. And if you don't have financial planners as referral partners, you should. And if you want to talk to your own, for instance, and say, you ought to meet with Dennis or Rick, we'd be glad to do that and show them. And they will then find more of their own clients and say, geez, yeah, I do this thing. Of course, then they need a realtor, so they hopefully call you. So I can talk about more, but I'll just.
That's great, Rick. That's really good. Both of you. I wanted to add a thought that maybe you guys could, maybe Dennis could comment on. I do know that occasionally we come across situations where somebody is in trouble. They think they're in trouble with their reverse mortgage, and it generally comes if they don't pay the taxes and insurance and they get behind. Isn't that one of the areas where the reverse mortgage can blow up on them? Dennis?
It's not that the reverse mortgage blows up. It's if they don't pay their property tax, the county might take their house.
Well, that's what I'm saying. But the reverse mortgage is contingent on their paying their taxes, is it not?
I think
FHA forces lenders to be pretty tough on that because they've got a security interest. And if it's sold to the county in 3 years, well, forward mortgages are the same.
Right.
But where seniors are probably more likely to, for whatever reason, fall behind the taxes. We have some things in place to prevent that. Nothing prevents everything, though.
Right. Gentlemen, you could go on. We could have a whole nother seminar on all that both know about HECMs, or reverse mortgages.
Are you busy next month? No.
Could arrange that. It's really been a pleasure to have you both come on board and give us this sort of bird's eye view. I know I've learned from this. I also want to say that we may have room for one question. Do we have anything, Dan, that anybody has asked yet in the chat room?
Other than comparing Tom Selleck's role in Magnum and Three Men and a Baby, there's one person who's asking what happens to the $100,000 that the client brings to the purchase. That example I gave, that $100,000 becomes the escrow for the interest that accrues when they don't make a payment. And depending upon how long they live there, the $100,000 may be used up. It may even, that's how it gets upside down if they live there too long. If they don't live there that long, it stays as equity in the house, and whoever gets the house gets that equity. So,
and that's really important. I didn't understand that until we met to discuss this. I mean, I had a hazy view. It's really been good to have you both clarify so much of what we have. Dan, is there anybody else that has a pressing question there?
Yeah, David Randolph asks, and Lauren's got one. If you do a reverse mortgage on your own home and that you're living in, what % of the appraised value does the bank give you back in cash?
It depends on the age of the youngest person on the title. The older they are, the more we can lend, because the less we need to hold in escrow for the potential interest that's going to accrue.
Yep, it prorates as you age. Got it. Cool.
Right. That's right.
Okay. Did Lauren have a question, or is she just?
I did. This was just an agent who messaged me. What is the minimum age to do a reverse mortgage?
62. At least one person has to be 62.
60. Okay, great.
60 or 62?
62.
Great.
62. 60 or 62?
No, 62.
62. Got it.
62. Got it. I want to thank all of our panelists. It was just really a great panel today, and I know I learned a great deal. And also our sponsors for helping to keep these events going. You all may know, but I'm going to reemphasize, these webinars are recorded and edited, and they're posted on the Real Estate Collaborative website, which is therealestatecollaborative.com. We also have our own YouTube channel, which you can go to and find the recording as well as previous recordings. Our next event is May the 27th in person at the DePere Lodge. Regulations and common sense prevailing. Otherwise, we'll default to a Zoom meeting. But we have 4 in-person events planned for the rest of the year, which is the first one being May the 27th. I know that many of you are missing your bacon fix. And so this will be an opportunity for you to catch up and meet face to face. There may be some regulations, but we will post all of that on the invitation. And we're looking forward to seeing in person so many folks that we've missed having contact. Maybe that's the wrong word given COVID, but having face to face greetings with and exchanging ideas. So we look forward to being with you all May the 27th. Thank you. Be sure to go to our website. Yes, go ahead, Rick.
Can I throw one thing out real fast for both Dennis and my benefit? The folks that think of a reverse mortgage as a purchase loan the same way they think of a forward mortgage as a purchase loan. It's
Okay,
a loan,
good.
cash, loan, cash.
Got it. Okay, good. So with that, again, thank you so much for attending today. Any suggestions, you're always welcome to email me at Barry, Barry, at mpastl.com. And we'll look forward to seeing you all, or many of you, May the 27th. Thanks again so much for being with us. Have a great week.